In this chapter, we evaluate different performance measures such as return on investment and residual income to evaluate if our division or an investment is performing the way that we would like it to. There are some definitions you need to know in this chapter, and I inserted the learning objective next to them because these definitions are not necessarily in bold on the side spelled out for you. You're going to have to read through the text and really understand in your own words what these concepts mean. And that's going to help you when we get down to all the equations, because there are a lot of equations in this chapter. So one thing I want you to do is note the gross margin, operating margin, and profit margin. Again, these equations are not spelled out for you in this chapter, but take a look at your income statement and just develop and write down here, how do I get to that gross margin? How do I get to that operating margin? And then how do I get to that profit margin? It's going to help you evaluate some of these other equations and just to understand the difference in these terms. And I also want you to note that we're working with a lot of ratios. We have the gross margin ratio. We have the operating margin ratio, the profit margin ratio. One easy way to calculate a ratio is just remember you're going to take that term, whatever it is, like gross margin, and you're going to divide by sales. Sometimes this is helpful to have these quick little hints next to your equations so that when you are trying to do the homework or looking through these equations, it's something easy to remember. So remember, anything that has the ratio, all we do is divide by sales. For example, your profit margin ratio. This is your after-tax income. It's where you're getting your profit from, and you're going to divide that by sales. I'm not going to go through all these equations with you, but in the examples we're going to use some of these, so I want to make sure you understand what they are in case you haven't read the chapter yet, and also because I want to show you how some of these equations relate to each other. The other equation that you're going to use is the asset turnover, and this is sales divided by your divisional assets. Now, some of you may remember from managerial accounting going through return on investment and going through residual income, and you're thinking to yourself, this doesn't look that familiar. And some of you are Googling some of these terms and you're not seeing these same equations. And I want you to understand that that's okay, that sometimes we have to kind of broaden our minds a little bit and understand that when we're looking at divisional assets, sometimes that means investments. So if you're Googling this, or if you're going through your homework and they're not laying it out exactly for you, an investment is an asset. So just know that these terms are sometimes interchangeable depending on what they're asking for, which I know can be confusing at times, but we have to understand the concept behind it so we can get to the outcome we want. And that's why when we are looking at return on investment, there are two options here, because the first one just lays out the equation for you. It's after-tax income divided by divisional assets. Again, this can come in the form of an investment. So, what does that mean? If you look at these three equations we just went through, that return on investment is a combination of looking at profit margin and asset turnover. If you did a little algebra, you would multiply them and then simplify by the sales. So we could also say return on investment is profit margin ratio times asset turnover. So depending on the information that you have, then you can calculate return on investment based on what's given. The other part we're going to go through is residual income. Residual income is your after-tax income and that's going to be subtracted by your cost of capital, which is usually a percentage, times your divisional assets. Again, if you're Googling this, you might see a little bit different terminology. Just know that they all relate to each other. When we're looking at economic value added, you can understand what this is. It's an adjusted annual after-tax income, subtracting out the adjusted total annual cost of capital. The problem here is that adjustment part. If you do research this, you'll see that these equations vary slightly, a little bit more than slightly actually. So we're not going to cover this. Read through it, understand what it is, but you will not be tested or asked to calculate that. So finally, let's go through some examples here. So in our first example, we're going to evaluate return on investment and your residual income. So we have to remember what those calculations are. And we'll pull those down here. So our return on investment, I'm going to use this one here. So I don't have to keep scrolling back and forth. And then I'm going to just use the information that's given and find the return on investment. They want it by these two different divisions, they have consumer and commercial. So if we look at the consumer first, we're looking for, I know my after-tax income, which they're giving to me here. And then they are going to divide that by our divisional assets. Now remember, if I look at this information given, the only asset I have is this investment. So I'm going to divide by that investment, and it's going to give me a return of investment of 14%. Now I can come and look at the other one, and I can compare these two divisions to see if one is performing better than the other one. This might come in handy if you know you need to make some cuts, or if you know that you need to make some changes and where those changes need to be. So again, I just pulled in that information from above. Remember that divisional investment is your divisional assets. And you can see, probably not a great example, but these are coming in exactly the same. So they both are performing equally as well. So that would be an example of, well, maybe I shouldn't be looking at return on investment. I have to review another performance measure to see if I can see which area is outperforming the other one. So I'm going to look to residual income. Now let me pull down that equation as well. so I don't have to go back and forth. I'll put this down here. So again, I'm looking at the two different areas. I did consumer versus commercial. This one was commercial. And we'll do these again. For consumer, I have to find the after-tax income, which they give us here, showing it as your divisional income. And then I'm going to subtract my cost of capital times my divisional assets. Now in the problem they tell me my cost of capital is 11%. So I'm going to take that 27,500 and I'm going to multiply by 11%. I'm going to subtract all of that out and I should get 825 would be my residual income. Now let's look at the commercial area. Again, I'm doing the same equation, taking that income and I'm going to subtract out 27,750 times that 11%. And here I'm going to get 832.50. So my commercial division is actually performing better than the consumer. Now remember, I was going to go through the EVA tool, but you don't need to know that. That's beyond the scope of this, and I don't want to confuse you any more than needed. But I do want to go through one other problem with you. And this problem, you have a similar one in your homework. The one in your homework looks at the beginning of the year asset values instead of end of the year asset values. But you can use this to kind of follow along and make sure you know how to do that. It'll give you a great example to follow. But make sure when you're reading through some of these problems, you read whether they're using beginning of the year assets or end of the year assets. In this problem, we're computing ROI, but looking at the difference between net book value and gross book value. And again, you're going to have to investigate really what those terms mean. I want you to do that so that you can understand that in your own words. It'll make more sense. But basically, the difference is the asset value. Am I taking into account the depreciation and then looking at the end of year versus beginning of the year? Gross book value does not account for the depreciation. So just comparing the differences in return on investment over the years, looking at these two different methods. So let's take a look at this. Again, we're looking at return on investment. So we want to know what is let me pull that down again. Go find that return on investment equation. So I don't have to keep scrolling back and forth. That equation doesn't change. But what we're going to put into it is going to change based on book value, using net book value or gross book value. So first, let's go through the net book value. And again, the difference is coming in the assets. We're looking at after-tax income divided by those divisional assets. We have to find all the information we need. This problem is rather wordy, actually. So going through it, let's see, we have depreciable assets that are 45 million, have a 4-year expected life, and can be salvaged for $9 million. That's important because we have to know what our depreciation is. They're using straight line depreciation. If you need a little reminder what that is, it's your cost minus your salvage value over useful life. So here, my cost is 45. I expect to get $9 million back. My useful life is, I lost it, I think, 4 years. Is that right? Yep. Therefore, I'm going to depreciate $9 million per year. Let's find some other information we need. Annual cash flows are 20 million. I will tell you, because I know you have a very similar problem in your homework, they're saying that in addition, they have 45 million in assets that are not depreciable, which means they have $90 million in assets. But they're also explaining this in more detail than you need. And they're actually giving you that $9 million in depreciation. So don't let all the numbers confuse you. Just pull out the information you need. Know that sometimes in these accounting problems, they're giving you much more information than you need to know. So let's look at this net book value method. I know my annual cash flows are $20 million. I'm going to delete all those zeros because I don't have enough space. I'm going to subtract out the depreciation to get to my income. And then I'm going to divide that, and this is year 1. I'm going to divide that by my total assets minus my depreciation. So here, I'm going to get $11 million over $81 million, which gives me a return on investment of 13.6%. Now looking at year 2, I'm going to do the same thing. Again, my after-tax income, that's not going to change. But what changes here is the fact that my depreciation is growing each year. I have to take that into account. So that $90 million is going to stay the same, but now I have 2 years of depreciation. So here, I'm going to divide by 72 instead once that math is done, and my return on investment comes to 13 or 15.3. And let's look at this one more year. In year 3, again, the income doesn't change, but now I'm looking at 3 years. So if I do a little math here, this comes to 63, which then causes my return on investment to grow to 17.5%. Now let's take a look at what our gross book value looks like. Remember the difference here between net book value, it takes into account that depreciation. Gross book value is just taking this equation as is, and that's it. So I know that my income, my after-tax income is $11,000. That doesn't change. My divisional assets are 90, which means my return on investment is 12.2%. That's going to be the same every year because I'm not taking into account that depreciation. Your book also talks about using return on investment with historical cost versus current cost. This is done exactly the same way. You're just changing those cost figures to represent either historical cost or current cost. Hopefully that helps. Please let me know if you've got questions.